In corporate finance, ownership is rarely a simple binary of owning a company or having nothing to do with it. It exists on a sliding scale. Where an investor sits on that scale dictates exactly how they must report their financial holdings. This slider represents an investor's stake in a company. In the bottom tier, ranging from 0 to roughly 20%, the investment is classified as passive. The investor holds shares, but they have no real voice in how the business operates. The dynamic shifts the moment that slider crosses the 20% threshold. At this exact point, accounting standards presume the investor now wields significant influence over the investee's day-to-day operations and policy decisions. This presumption of influence remains active until the stake hits the 50% mark. Past 50%, the investor generally assumes outright control, which forces them to completely consolidate the investee's financial statements into their own. That leaves us with the critical middle ground. Within this 20 to 50% window, the investor operates as a shadow partner. They don't have total control, but they have a loud voice at the table, requiring a completely different reporting framework. This specific shadow partner dynamic triggers the mandatory use of what is known as the equity method. There is a vital condition here. This presumption of influence strictly requires the investor to hold voting interests. In almost all corporate structures, that means holding common stock. There is one notable exception to this mandate. The equity method applies assuming the investor has not elected the fair value option, or FVO, for their reporting. The core logic of the equity method is synchronization. It forces the investor to record the investee's financial performance as if those events were occurring within their own company in real time. Accountants utilizing this method stop watching the daily fluctuations of the stock market ticker. Instead, they track the investee's actual operational victories and defeats, baking those outcomes directly into the investor's balance sheet. Let's build the model using this equation. Assume Company P purchases a 30% ownership stake in Company XYZ on May 1st. Company P pays $200,000 for the shares. The initial recognition is recorded at cost, establishing the new asset. At the end of the year, Company XYZ reports $60,000 of net income. However, Company P did not own the shares for the full 12 months. The proration rule states that an investor can only recognize earnings for the specific window of time the stock was held under the equity method. Purchased May 1st, Company P held influence for 8 months. We take 8/12 of the $60,000 income multiplied by the 30% stake, yielding $12,000. The investment asset increases by $12,000, perfectly balanced by a $12,000 revenue increase. Under the equity method, an investor's claim on earnings requires two specific inputs: the percentage of ownership and the precise calendar window in which that influence was actually held. Let's advance the timeline to year 4. Company P now exercises its 30% influence over XYZ for the entire 12-month reporting period. For year 4, Company XYZ operates highly effectively and achieves a net income of $100,000. Because there is no proration required this year, Company P calculates its direct share simply by applying its flat 30% stake. The result is $30,000. This creates a dual impact on the books.
First, this $30,000 directly increases the carrying amount of the investment in XYZ asset account. Second, that same $30,000 is simultaneously recognized as investment revenue on Company P's own income statement. Because the investor holds significant influence, the investee's bottom line growth is functionally and structurally treated as the investor's own growth. At the end of year 4, Company XYZ declares and pays out a $20,000 cash dividend to its shareholders. Intuition suggests that receiving a cash check from an investment should trigger new revenue on the income statement. Under the equity method, routing a cash dividend to revenue is a critical reporting failure. Company P owns 30% of the business, meaning their exact cut of the $20,000 payout is $6,000 in cash. Looking at our equation, Company P's cash asset account increases by this $6,000, but look at the offsetting entry. Receiving a dividend decreases the carrying amount of the investment in XYZ asset account by $6,000. Nothing touches the revenue column. The economic reality is the dividend is simply a return of the investment. It converts a previously recognized illiquid asset back into liquid cash. The investor already claimed the income when the investee initially earned it. Recording the dividend as revenue would be double counting the exact same dollar. Testing our model, Larkin starts with a $200,000 balance. Their 25% share of the $600,000 net income adds $150,000. Finally, their share of the $400,000 dividend removes $100,000. The starting $200,000 plus the $150,000 income share minus the $100,000 dividend share leaves a final year-end carrying amount of $250,000. This sequence formalizes into the definitive equity method roll-forward equation: beginning balance plus income share minus dividend share equals ending balance. This continuous formula is the operational heartbeat of the equity method, perfectly tracking the expansion and contraction of an investor's influence over an asset's lifespan. Let's pivot to a final edge case. How does the math respond if an investor holds two different classes of stock? In this scenario, the company owns 30% of the common stock alongside 100% of the preferred stock. Recall the strict boundary established earlier. The presumption of significant influence is tied exclusively to voting interests. Common stock carries voting rights. Therefore, the 30% stake easily triggers the use of the equity method. Preferred stock, however, is inherently non-voting. Because it lacks a vote in the boardroom, owning 100% of the preferred stock grants zero significant influence under GAAP. This splits the reporting paths. The common stock dividend share bypasses the income statement, merely reducing the investment asset. Conversely, the preferred stock dividend falls entirely outside the equity method. Therefore, the full $60,000 is recognized immediately as dividend revenue. Returning to the scenario's core question, the total amount of dividend revenue the company should report on its income statement is exactly $60,000. Under the equity method's rigorous logic, reporting is never dictated by the raw cash collected. It is determined entirely by the voting power you wield.